So here we are in Europe, and we were joking on Twitter when we were looking at the German prices, PPI exploding higher, and then Spain just outdoing Germany, and the pressure that continues. So now you have Poland. So Russia has said that starting today, they're not going to send gas to both. I think right now they're at Poland, Germany, and what was it? There was one other, I think Lithuania. When you look at just because the countries refuse to pay in rubles. And the reason why is because it would be a breach of their sanctions. So again, that's now. So now you have Russia saying that they're going to turn off that gas, which is obviously going to lead to more pressure. Because even though there's obviously been fighting back and forth, they typically import about 110 MCM a day, and they're down to about 92 MCM a day. So you're still, even though it's down, you're still getting that gas coming through. So that is only going to send prices higher. So that's when we start looking at Eurozone Aggregate. CPI was expected at 7.5, came in at 7.4. Consumer confidence was expected at negative 20, came in at negative 16.9. So again, some of that, CPI is the thing that we think is going to continue to go up, as we showed in segment one. Then when you start looking at the Eurozone manufacturing was expected at 54.9, came in at 55.3. Eurozone services were expected at 55, came in at 57.7, bringing the total comp to 55.8. Excuse me. But the biggest issue that I want to highlight in that, and we've talked about this before, the supply chain is getting worse in Europe. And that is a positive contributor to this. So prices paid, prices received, and supply delays are technically positive numbers. But when you look at how it impacts sales, how it impacts the economy, it has a negative impact. So that's when you start looking at it. Something very similar happened here, and that's when we started to see, which is why we wanted to discuss some of those different pieces, as construction remained fairly stable in February, but got a little bit slower in March. Now, some of the things that we want to look at are the leading indicators that China and Europe, because as we've been talking about over the last 12 to 18 months at this point, trade between China and Europe has increased. And Europe is actually the biggest, on a percentage basis, was the biggest increase in European goods, Chinese exports and European flow. So when you start looking at China implies downside risk because the PMIs in Europe are reliant on China buying. So as China doesn't buy, Europe is going to struggle to sell, which again is going to lead to some of those additional problems. China PPI points to downside for the Eurozone rate. When you look at China PPI and then where the things are going in terms of the Eurozone piece, there's very specific pieces to this because yes, you can take energy out, but raw materials are still readily available for China. And that's, relatively speaking, but Russia is not sending raw materials to Europe. They're not going that way. And a lot of raw materials come from Russia into Europe. A lot of raw materials from Ukraine come into Europe. China has a different flow, and they're still speaking to Russia in neutral terms, but they're still going to get some of that volume. So again, this is where we get some of this pressure on. Yeah, it'll more flatline it than it will draw it down while we get some of those different pressure points, or I should say until we get some of that demand destruction. Eurozone industrial production, you can see it's holding in here. Same with Eurozone manufacturing production. Those are things that are for February. But again, March is really where we see that pressure because the end of Feb was when Russia moved into Ukraine, and that was when we saw some of those other difficulties. Market pricing for ECB rates by the end of 2022. The market is pricing in that they're going to have to raise rates, which is not something that Lagarde wants to do based on what she had said about trying to continue quantitative easing. But the market is, and as we wrote about, yield is going to, and rates are going to force central bank hands. And this is a perfect example. So when you look at market Eurozone composite, you get an idea of kind of where we sit versus historics, kind of going sideways, but output prices exploded to new highs. And this is what we were talking about. output prices are just that huge indicator, because we were assuming things were just going to go sideways and then move up, but not to this level when you factor in the looking at April, because April obviously encompasses all of the issues between Ukraine and Russia. But you're getting an idea of just where those prices are going. And then the supplier delivery times are still getting longer. And this is what we're talking about. The U.S. got a little bit better. It's still gotten better. It's going to start to get a bit worse. But ours got better. We've gone in two different directions, where Europe has gotten worse while we've gotten better, and now we're going to start to get worse just as they get worse again, which is just leading to more of those pressure points that we've been talking about. Now turning to Germany, you can see that German manufacturing was right in line at 54.1. Services came in a bit higher at 57.9, bringing the composite expected at 54.1, came in at 54.5. Now we did get a bounce on IFO expectations. Business climate was expected at 89, came in at 91.8. Current assessment came in at 97.2 versus the estimate of 95.9. IFO expectations came in at 83.5 versus the expectation of 86.7. But consumer confidence in May was expected at -16, came in at -26.5. So again, now you're starting to get this disconnect where the consumer's feeling pain and the business side is going to come down. But remember, the last IFO number was a huge drop. So it makes sense to get a little bit of a bounce, and then again, like a bounce and then a fade in terms of where those expectations are going. So this is just highlighting what I was just saying, where you had a huge drop last month. So to get a little bit of a bounce is not a huge conundrum. It doesn't show that things are turning. It's just that a lot of the bad has now been priced in from the IFO side. And when you look at just where does that put you? Well, at business, it puts you business, manufacturing, business climate, slightly negative, business expectations, severely negative, just less negative. Then when you look at service sector, it's essentially climate slightly positive, expectations slightly less negative. So when you look at the blue lines, they're all in contraction. When you look at the red lines, they're all in contraction or slight growth, but moving in the wrong way, where when you look at the assessment of the business situation, it's fairly flat. So we do think that you're going to get a bit of that rollover as pressure continues to mount on the economy, driven by, obviously, the multitude of factors. German PPI was expected at 30%, came to 30.9%. Again, all of this leading to more pressure and more problems that we see across the economic footprint. And then the German 10-year break-evens edged above U.S. equivalent for the first time since 2009. Not a good indication for where Germany is going to go. And again, speaking back to rates and a lot of these pressure points that we continue to see on the underlying backdrop. So one of the things that we then look at, German Manufacturing PMI, even though it's still positive, moving further negative, but new orders is now negative. So again, the new orders is the leading indicator, which is more of that pressure, more of those problems that we continue to see throughout that time period. So then when you start looking at German manufacturing PMI, new export orders also in contraction, very negative, coming at 47.5 and moving in the wrong direction. Services PMI, as we explained, went back up based on what we had discussed. But again, the leading indicators, the new export orders, prices, all of that, delivery times, all of that is a net negative for economic expansion. So then when you look at Spain, the PPI was expected to be came in at 6.6%. And then if you remember, we had Germany coming in at over 30% year over year. And Spain came in at 46.6%. Going back through the 70s, that is the worst number ever, and by a country mile, which leads to all of the pain and the problems that we see with pigs coming back, which is, for those that don't know, Portugal, Ireland, Italy, Greece, and Spain, with obviously Ireland in a different position this time, Greece kind of a no man's land. But when you start looking at Spain continuing to be that bigger problem. So then when we look at France, consumer business confidence right in line, manufacturing confidence same. The manufacturing was expected at 53.7, came in at 55.4. Services expected at 56.5, 58.8 was the actual number, and the composite coming in at 57.5, better than estimates. But consumer confidence also dipped, expected 92. Came in at 88. So some positives, but they also have the same problem when you look at some of the leading indicators. So when you look at the manufacturing piece and services piece, it all looks really good. But then when you go internally, you look at the consumer when you go internally, you look at that where you have delivery times expanding, you have prices at records, you have prices received, prices paid, all of that going up, with new export orders coming down, with new expected export orders coming down. That is again where we see something similar as that slowdown continues to slide. On the UK, I just threw in the UK because I thought these were some scary numbers. When you look at consumer confidence, was expected at negative 33, came in at negative 38, which is worse than COVID, worse than the European financial crisis, and closer to the global financial crisis, if you will. UK retail sales dropped like a rock and is now below where it was, above where pre-COVID, but is now bucking the trend when you look at that trend line. And then when we turn to PMI output prices in the UK, back to a record, and then UK manufacturing PMI coming in fairly flat. But again, delivery time delays, output prices record, input prices record. So there's a certain amount that continues to be the struggle. And those are things that are not unique to Europe, but elsewhere. It's just they're further along, and they have the most impact from what is happening between Russia and Ukraine, creating a lot of these underlying problems that will only continue. So that's what we have for Europe. In the next segment, we're going to look at China and Asia and what is happening in that region as well.